This year, I believe we will definitely see even more banks collapse. What they're trying to do is engineer a soft landing. But the problem is that we are transitioning into a new system. So there's no such thing as a soft landing. They need a crisis. So I think we will see even more banks collapse this year. Every bank, including every central bank, is deeply underwater. It's like all we see is the very tip of that iceberg, but the danger lies in what we do not see. And that's held really privately underneath that water.
The 2023 banking crisis that resulted in the collapse of 4 banks, including Silicon Valley Bank, appears to have been resolved through public intervention. 4 mid-sized U.S. banks failed around March 2023, the most notable being Silicon Valley Bank, SVB, which became the second largest bank failure in U.S. history after Washington Mutual's collapse in 2008. Over 90% of SVB's deposits were uninsured, making them susceptible to runs. Following SVB's collapse, the Treasury assured that uninsured depositors in small banks wouldn't suffer losses in future bank collapses. Additionally, the Federal Reserve initiated the Bank Term Funding Program, BFTP, providing loans for up to 1 year to banks based on the face value of the securities they held, without adjusting for potential erosion due to higher interest rates. The Federal Reserve's bank bailout program recently ceased operations on March 11th. What lies ahead? Lynette Zang suggests that the recent termination of such programs implies their underlying purpose, to enable banks to profit easily through arbitrage. This involves borrowing at low interest rates and investing in treasuries at higher rates, effectively generating risk-free profits. Similar tactics were observed during the 2008 financial crisis, when banks earned interest on reserve assets for the first time. Despite the discontinuation of certain programs, tools for creating liquidity, primarily through money printing to support banks, remain available. Lynette highlights an often overlooked fundamental issue concerning bank insolvency. Banks, including central banks, face significant challenges due to their substantial holdings of government debt acquired at low or negative interest rates. With interest rates rising to counter inflation, the value of these assets has plummeted, posing a considerable threat to financial stability. This insolvency extends beyond commercial real estate, impacting various sectors such as mortgages, auto loans, student loans, and credit cards. Moreover, the derivatives market exacerbates these risks by betting against this debt, further amplifying systemic vulnerabilities. We will present clips from Lynette Zang's interviews with the Kitco News. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
It's interesting because you have to look at all of the programs that are in place. The one that they've just canceled was pretty obvious that it was set up for the banks to make free money and create an arbitrage circumstance where they could go into that program, borrow at lower interest rates, and then take that same money and invest it in treasuries at a higher interest rate. And that's basically making free money. So once that was discovered, they couldn't extend the life of this program. They had to shut it off because that's exactly what they did in 2008 when they decided to, for the first time, pay banks interest on reserve assets. So, but there are so many different ways and so many different tools that they have to create that. I don't really want to call it liquidity because it's just money printing, right? And giving it to the banks to support them. Yes, every bank, including every central bank, is deeply underwater. It's like all we see is the very tip of that iceberg, but the danger lies in what we do not see. And that's held really privately underneath that water. So it's all about interest rates, right? And what I find really interesting is that all of this money printing and all of this money creation has essentially, there's no value in the currencies anymore. So that's not a new thing. And it's not just the US dollar going away. It's actually the entire financial system that has to reset into that new system. So taking away any stigmas of bank borrowing, but they are all insolvent, every single one. Because what have the central banks been doing, right? They've been buying up all of this government debt with interest rates at zero or even negative. So now that the interest rates are pushed up to quote unquote fight the inflation, all of the valuation of all of that debt is way underwater. So in commercial real estate, it's not just commercial real estate. Certainly, we're watching a lot more buildings being given back to the lenders. But if the valuations of all of the banks, including the central banks, are based on debt, which they are because the entire system is based on debt. This is a debt-based system. Those interest rates have pushed down the market valuations of all of that debt, not just bonds, not just mortgages, but it's also auto loans, student loans, credit cards, and then all of the mountains, trillions and trillions and quadrillions of derivative bets against that debt or against that credit quality. So yes, every single central bank, every single commercial bank, community banks typically do not take those kinds of risks, but they're sitting with all of that commercial real estate, other real estate that is at nosebleed level, multifamily, single family. All of that debt is underwater. All of it.
The global exploration of central bank digital currencies, CBDCs, has seen significant momentum, with 134 countries and currency unions currently representing 98% of global GDP. This marks a notable increase from May 2020, when only 35 countries were considering CBDCs. Presently, 68 countries have progressed to the advanced exploration phase, with 19 of the group of 20 G20 countries actively developing CBDCs. 11 nations, such as Brazil, Japan, and India, have already reached the pilot stage. Lynette Zang observes a recurring pattern in transitioning to a new monetary system, often triggered by a crisis compelling voluntary compliance. She warns of the potential for a significant crisis if individuals are unprepared, leading to the distribution of CBDCs to stimulate spending. Addressing the Senate, Federal Reserve Chairman Jerome Powell underscored the cautious approach of the Fed towards the digital dollar concept, emphasizing that the U.S. is currently distant from any CBDC implementation. Powell's remarks coincide with increasing global discussions on the potential and implications of central bank-issued digital currencies.
First of all, I want to say that we're nowhere near recommending or let alone adopting a central bank digital currency in any form.
Lynette believes there's more to the story, suspecting that CBDC development is further along than authorities admit. The banking system, already a central player in monetary policy, seems poised to facilitate the introduction of CBDCs.
And the reason is because you can see the patterns every single time, and there's so much data on this, but the patterns of how you make this transition into a new system. And you need a crisis that's large enough to scare the people enough to comply and just to volunteer. And if you're not prepared, well, what's going to happen is there's going to be this huge crisis. They're going to give us all a whole bunch of CBDCs to go out and spend. And, even though Fed Chair Powell says, oh, we're not even close to it, blah, 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 they're running tests. So here's the thing. Their job is to lie. And I don't frankly believe him, because his job is to keep us calm and keep us in the system. If we really thought that there was going to be a banking crisis, are you keeping your money in the bank? No, you're going to go pull it out. And then that just exacerbates their problem, because there is not enough. There's barely anything in the FDIC DIF fund. So I think they're much further along than they want us to believe with a central bank digital currency. I think you look at, we're the largest economy, and then China's the second largest economy. If you look at the Bank for International Settlements, which is the central bank, and you look at their monetary flower, then you see that they use they mention both wholesale and retail CBDCs inside of that. So he's just saying it and time is going to tell whether or not he's telling the truth, or they're going to find some kind of justification for all of a sudden, well, look we've got this ready. And I think what's going to happen, I think it's just going to be sprung on us. The question is not will they do this and is that it? Because it won't be it. When they first bring the CBDC out, it will not be the end of it. It'll just be another tool in the transfer. Because what the central banks talk about is that it eliminates it eliminates the need to keep interest rates in a positive territory. These are their words. Once we have a CBDC, there are no limitations to how low we can push interest rates, which really means eat your principal because they've already gotten all the purchasing power out of it. So maybe he's telling the truth, but that's not his job. His job is to keep us calm and protect the banks. So to do it through the banks doesn't make it any better, because that was an issue that they had to resolve. They had one directly with the public, then what happens to the banking system? And the banking system is their mechanism to distribute their policy.
Gold prices soared to a new record high of $2,081.82 per ounce in the futures market, briefly surpassing the previous peak of $2,075.14. This milestone occurred shortly after the collapse of First Republic Bank, marking it as the second largest bank failure in U.S. history. Alongside First Republic, Silicon Valley Bank and Signature Bank also faced closure, surprising many as they were once esteemed banking institutions. This surge in gold prices reflects a broader trend of investors seeking refuge from uncertainty, a weakening U.S. dollar, and heightened market volatility. Share your thoughts on Lynette's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.